All right, get ready for today's deep dive. You guys sent in a pretty interesting mix of market analysis and commentary, all from February 12th, 2025. Looks like it was a wild day. We've got pieces from those Benzinga trading shows, some analyst reports, even some historical market data.
Yeah, February 12th was definitely a day for the books.
And to help us make sense of it all, we have, well, an expert in making sense of things,
I try my best.
ready to uncover some market secrets.
Always. You know, what really stood out to me in all these sources is that tension between reacting to the news and focusing on the long term.
Yeah, it's everywhere in this batch of sources, especially on a day like February 12th, which started, by the way, with that dramatic CPI release, remember? Inflation was hotter than expected, and the market kind of freaked out.
Totally. Everyone was expecting CPI to be around 2.9% year over year, but it hit 3%. And even crazier, it was a 5.1% jump month over month.
Oof, that's a big jump.
Yeah, one analyst, Tim Melvin, said the market's reaction was like dinosaurs trying to tap dance on a tightrope.
Okay, that's a visual.
One wrong step, and, well, you can imagine.
Wipeout. Okay, so inflation is bad. We all know that. But what does it actually mean for, the average person who's trying to manage their money or maybe start investing?
It's about your buying power. Inflation eats away of your savings, makes it harder to figure out where to put your money.
So if you ignore it, you're basically just letting your money slowly disappear.
Kind of, yeah. And this CPI release shows how inflation can suddenly shake up the whole market. So understanding it is important no matter how much experience you have.
Makes sense. And speaking of shakeups, let's talk about AI stocks, which were also making big moves on February 12th. Meta especially was all over the news with that big surge, almost 18% in just a couple of weeks.
Right, and we saw analyst Dan Ives was super bullish on Meta. He sees a huge opportunity for them to make money from AI. Seems like Zuckerberg's been investing a ton in all sorts of AI projects. Kind of interesting considering their track record with new stuff, you know?
Yeah, it's like they went from the metaverse to like the AI-verse overnight, but are we surprised every company's trying to get in on the AI action right now?
True, true. But Meta's different, right? They've got this huge user base, tons of data. That gives them a big leg up when it comes to training AI models and creating new applications.
Makes sense, but can they actually make money from it? Their history with new ventures isn't exactly encouraging.
Yeah, fair point. But Ives argues they're finally getting it. He sees potential in things like targeted advertising, content creation, even virtual assistants. It'll take time, but he thinks Meta has what it takes to be a major player.
Interesting. So we've got Meta, the big guy in the room, but there were some smaller companies making waves in AI too, right? One that caught my eye was Supermicro Computer. Not exactly a household name, but apparently they're big in AI hardware.
Oh yeah, they had their Q2 2025 earnings call that day, and they were really excited, talking about huge growth thanks to all the demand for their AI and liquid cooling technology.
Liquid cool, like for computers.
Exactly. Keeps those powerful AI systems from overheating.
Makes sense. But didn't they have some problems a while back? Something about their accounting.
You're right, they did have some issues in 2024 that spooked investors. So yeah, there's this cloud hanging over them, and they're in a race against time to file updated financial statements, regain everyone's trust.
So it's high risk, high reward. They have the tech, they're riding the AI wave, but can they actually deliver?
That's the million-dollar question. It just shows how a company's past can affect their value, even if they're doing well right now.
Yeah, how much should you focus on a company's history when you're trying to figure out their future? It's a tough call.
Totally a balancing act. You don't want to write off a potentially strong company because they made mistakes, but you've got to be aware of the risks.
Okay, so we've got inflation making everyone nervous, AI companies, both big and small, making big moves. But let's switch gears for a second, talk about, day trading, where things move at warp speed.
Oh yeah, the world of instant wins and losses. Buckle up.
Right, the Benzinga shows were going crazy, analyzing those wild stock swings in real time. One that caught my eye was Lyft. Their stock tanked after earnings, even though they beat revenue expectations.
Classic example of how options trading, which they talk about a lot on the shows, can really magnify your gains and losses.
Double or nothing. And then there was C3.ai, another AI company, but known for being pretty volatile. The traders were watching it like hawks, trying to make a quick buck. You'd need nerves of steel for that.
That's day trading for you. It's high stakes, fast paced. You need to be able to make decisions on the fly, manage risk, and really understand the market.
They were even talking about using Fibonacci retracement levels to try and predict where a stock might go next. Sounded super complicated.
It's basically using a mathematical sequence, sounds crazy, I know, to identify potential support and resistance levels for a stock price.
So it's not totally random. There's some method to the madness.
Right, it's a form of technical analysis. And yeah, good day traders use a mix of technical analysis, news, and market psychology to make their decisions.
Okay, so there's more to it than just luck. But it's still super risky, right?
Definitely. Day trading is not a get-rich-quick scheme. It's a game for pros, or at least for those who really know what they're doing and can handle the risk.
Probably good advice to leave it to the experts, or at least be really careful.
I agree.
Okay, let's all take a deep breath after that whirlwind tour of day trading and talk about something a bit calmer. Long-term investing, where patience is key.
Ah, yes. Back to basics, focusing on the fundamentals.
And Jim Meldon had a great segment on this. He analyzed, like, historical stock market performance, basically laying out a plan for long-term success. What were some of the key things he emphasized?
He said that the companies that win over time aren't necessarily the ones that are super flashy and high growth. They're the ones that consistently grow their earnings over decades.
Slow and steady.
Exactly. He even used companies like railroads, defense contractors, and materials companies as examples. They might not be the most exciting investments, but they've done really well over the long haul.
He even mentioned Vulcan Materials. They've been quietly making money from concrete since, like, 1926. Who knew?
Right. It shows that sometimes the best investments are the ones that are under the radar, the ones that provide the essential stuff we all need.
So consistent earnings growth is key. What else did Melvin highlight as important for long-term investing?
He was really into dividends, not just because they give you a steady income, but also because historically they've been a good sign of how a stock might perform in the future.
It's like getting paid to wait for your investment to grow.
Exactly. And Melvin made a really strong case for why value investing is still relevant, even though some people think it's dead.
Yeah, he was all about finding those undervalued companies, especially the ones with strong financials.
He talked a lot about return on capital, earnings yield, that sort of thing.
And he even challenged this idea that book value doesn't matter anymore.
Right. His research showed that companies with low price-to-book ratios often do better, especially when you look at other quality metrics, too.
So basically, don't just dismiss those boring companies.
Exactly. And he had this whole list of companies that fit this profile. Lansec, which makes building products, Scholastic, the kids' book publisher, and then a bunch of banks and mortgage REITs.
Oh, and Redwood Trust. They had a 10% dividend yield, if I remember correctly.
That's the one. It's a good reminder that there are always opportunities out there for investors who are willing to do their research and look beyond the hype.
So while everyone was freaking out about inflation and chasing AI, Tim Melvin was over here like, hey, check out these solid companies that are making real money.
Totally. He was a voice of reason amidst all the chaos.
I like that, a voice of reason. But speaking of companies with potential, let's circle back to Supermicrocomputer for a sec. They were supposed to present at that TD Cowen Tech conference that afternoon, right? And there was a lot riding on that presentation.
Yeah, it was a big moment for them. Remember, they were trying to get those financial statements filed, put those accounting worries to rest.
And the Benzinga hosts were glued to their screens watching Supermicro's stock like hawks, especially after that jump in the pre-market.
It was a wild ride, wasn't it?
Up, down, all over the place.
The stock went up over 4% at the open, hit $148, but then it dropped, traded as low as $140 before recovering a bit.
They even mentioned that the bid-ask spread was huge, which is usually a sign that things are volatile and uncertain.
Right. A wide spread means there's a big gap between what buyers are willing to pay and what sellers are asking. Makes it tough to trade.
So even with all the excitement about their AI tech, Supermicro still had to work hard to get investors to trust them again.
Definitely. This shows that market sentiment, how people feel about a company, can really affect the stock price.
Even if the company's actually going well.
Exactly. It's about looking at the big picture, the market, investor psychology, news, upcoming events. It's all connected.
Speaking of news, wasn't there another big story that day? Something about Trump and tariffs.
Oh yeah, he was back at it with the tariffs. And this time it was steel and aluminum imports. Raised tariffs to 25%.
Didn't go over well, did it?
Not really. People were worried about a trade war, especially after the EU said they might retaliate.
Yeah, the market definitely didn't like it. So tariffs, what's the big deal? Why should the average person care about them?
Well, tariffs can make prices go up for everyone, disrupt those supply chains businesses rely on, and even slow down the entire economy.
Not good. And in this case, it just added to the uncertainty that was already in the market.
Right. Investors were trying to figure out what it would mean for company earnings, global trade, even what the Fed might do. It was a lot to take in.
It sounds like February 12th was a real nail-biter for anyone following the markets. Inflation, trade wars, the Fed trying to keep everything from falling apart.
And speaking of the Fed, we can't forget about Jerome Powell's testimony to the Senate that day. It was his Humphrey Hawkins testimony, where he talks about the economy and what the Fed's planning to do.
Oh, right. This was a big one, especially with that hotter-than-expected inflation report.
Everyone wanted to know if the Fed was going to change course.
So what was the verdict? Was he panicking? Or acting calm and collected?
He was actually pretty measured. He said, yeah, inflation is still higher than we want it to be, and yes, we're committed to bringing it down, but he also emphasized that they'd be patient and thoughtful in their approach.
So basically, they weren't going to do anything drastic, even with inflation being a problem.
Yeah, they wanted to project an image of stability, show the markets that they had a plan.
But it wasn't just about inflation, right? Didn't Powell get questioned about a bunch of other stuff, too?
Oh, yeah, they grilled him on everything. Bank regulations, climate change, even cryptocurrency.
It's like the Fed is supposed to be an expert on everything these days.
I know, right? It shows how connected everything is in the financial world and how what the Fed does can affect so many different things.
No pressure, right? Okay, let's go back to those Benzinga shows for a minute. There was so much energy, everyone reacting to the news in real time. It was like a crash course in how traders think.
One trade that stuck out to me was on Upstart, that AI lending platform. Their stock was up over 20% after hours because they had great earnings.
Wow, that's a big jump. What happened? Was it just the earnings report or was there something else going on?
Well, the hosts were talking about how Upstart had a lot of short interest. Basically, a lot of investors were betting against it.
Betting that it would fail.
Exactly. And when a company with that much short interest beats earning, like Upstart did, it can cause a short squeeze.
Oh, right, right. Remind me how those work again?
Basically, when the stock price goes up really fast, the people who bet against it, the short sellers, have to buy shares to cover their losses, which pushes the price up even more.
So it's like a chain reaction.
Yeah, totally fueled by, panic, basically.
So in Upstart's case, their good earnings caught those short sellers by surprise. And they had to scramble to buy those shares, which sent the price through the roof.
Exactly. It's a good example of how market sentiment, how people feel about a company, can be just as important as the actual numbers.
It's like sometimes perception is reality when it comes to the market.
Sometime, yeah. And it also highlights the risks and rewards of short selling. It can be a good strategy, but it can also blow up in your face if you're on the wrong side of a short squeeze.
Makes you think twice before betting against a company. But speaking of thinking differently, Tim Melvin had this really interesting take on the whole AI craze. He said that investors might be missing out on opportunities in more traditional sectors that are actually benefiting from AI in a less obvious way.
Yeah, he was saying that some of the companies providing like the infrastructure and materials for all this AI stuff are trading at much lower valuations than the AI companies themselves.
It's like focusing on the picks and shovels during a gold rush instead of just the gold.
Exactly. It's about thinking outside the box, looking beyond the hype to find those hidden gems.
So while everyone was going crazy for AI stocks, Tim Melvin was over there saying, hey, maybe check out concrete, building materials, even children's parks.
Right, because innovation needs a foundation. And sometimes the companies building that foundation can be really good investments.
That's a great point. Well, that wraps up our deep dive into February 12th, 2025. It was a day full of surprises, from inflation to AI to the crazy world of day trading, and we even got a reminder about the importance of long-term investing.
Definitely a lot to learn from this one.
Absolutely. But before we go, I want to leave you with something to think about. With all this focus on AI, what other industries might be flying under the radar? What other hidden gems are out there waiting to be discovered?
Do your research. Don't be afraid to think differently. And remember, sometimes the best investments are the ones that take a little digging to find.
Great advice. Thanks for joining us for this deep dive. We'll be back next time with more insights from your world of information. Until then, keep learning, keep exploring, and keep diving deep.